appreciate that. It's been an unusual audit year, is maybe the way I'll say it. And I think it's really important to have somebody who's willing to converse frankly and frequently with their auditor. So I appreciate that. And, I would love to talk a little bit more with the audit committee as in terms of a debrief on one of the things that we committed to early on was pretty regular, frequent, detailed communication with you. I think our audit updates probably were a little painful to open up and try to figure out. We tried to make them as straightforward as possible and really communicate very, very frequently with you. So I hope this year you felt like at least you knew the status of what was going on, what was outstanding, even though it took a little bit longer than is typical. I appreciate you being available and getting those up, asking for those updates, because I think it did help everybody, especially our team, just to know what's going on. I'm also really excited, Don, I haven't met you yet, but I'm glad to see you sitting here. So welcome. And I look forward to talking with you further as we move forward, because I think some of the things that we'll talk about today really are about prospectively looking at how the municipality can move from what's in here to what your future will be, and as your auditor, but also what I would consider to be an active citizen of the municipality. I would love to see, the changes that need to be made fairly quickly. So I'm sure, Don, that you'll have a role to play in that process under Alden's leadership. So with that, you have a few things. I didn't reprint out. Technically, you print these. Your print shop prints bound copies of the ACFR. So we call this the ACFR. It's the Annual Comprehensive Financial Report. This is your financial statement. It's posted online. It's also available. You can see it here on the Audit Committee website. It's was issued on July 12th. And the ACFR is called the Annual Comprehensive Financial Report. That's why we call it the ACFR. And it includes lots of different information. It's about 200 something pages. I'm not going to go through every page of the ACFR with you. And one thing that you as an audit committee could request, and I know there's been talk with the assembly chair about whether or not to do kind of a work session or executive session around some of the financial information that's contained in the ACFR, because I think there's a lot of things that come out of the ACFR this year that we can really dive into if we want to in that type of session to really look at some of the numbers. I'll touch on a few highlights for you, but I also would really encourage you, especially as the audit committee, to to ask questions on the financials. What you don't have this year in the final issued statements is what we call a management discussion and analysis, MD&A. And you have historically presented an MD&A. The MD&A is presented by management. The idea is to provide sort of a summary narrative on the main areas of the financial statement audit results, the main areas of the financial statements that would be important for you to know. Big changes in debt, big changes in capital assets, what happened with revenues during the year compared to prior years. This statement does not include the MD&A this year. So that's a little bit of a disadvantage for you as an assembly person to be able to decipher these many, many numbers that are included in here, because the MD&A has historically been able to give you that information. That being said, the MD&A has been prepared in the interest of time to get these statements audited and issued. The decision was made not to include it because there were edits being made to the financial statement numbers, really all the way up to the end. So trying to also make those through the MD&A and get that issued wasn't the priority. The priority was issuing the financial statements in a timeline that you needed them issued. So that was a decision that was made to facilitate getting these out. But I will just say that information might be helpful for you just to understand the changes from last year to this year, what's kind of the trends in the financial statements, and something that would be worth kind of talking with your management team about, because at least the information was preliminarily prepared and is available. Go ahead.
Yeah, thank you. So I just want to make sure I'm understanding you correctly. So the MD&A is done. It just wasn't included in the ACFR because you were trying to meet the deadlines and just couldn't happen. But there is an MD&A that's done.
It's been drafted. I don't know that it's been, the final updates to it have been made based on the final financial statements, but that would not be a heavy lift. Okay. Not my call whether that gets done, but that's something that if you look at last year's versus this year's, it'll be a very glaring difference because you're used to seeing that. And in my experience, that's something that oftentimes the assembly members actually want to read that. That's really the only thing you would maybe read because it
Right.
gives a little bit more narrative form financial information to
Sure.
you.
I guess then a question to the administration, is that something that the administration is willing to complete and then send to the assembly?
If the assembly is interested in that, we can certainly pull away people from the 23 and 24 to go back and write up what happened in 22. I will say that another section that tends to go along with that is, and it's not probably in this one, is the statistical section. I can tell you we did do that afterwards because it is a requirement of our bonds. And we did do that, and we did actually issue that separately in the bond world so that they had the statistical section. But both the statistical and the MD&A probably are not in this document. However, we did do the statistical section and put it online for our bondholders because it's a requirement, kind of like a day or two after the ACFR was issued. But if the assembly is interested in the MD&A, we can, as Joy stated, I'm well aware a draft was prepared like around the March time period. The key is just going in and making sure that the final numbers that were in the ACFR are actually in the MD&A that might have changed since that draft was prepared.
Thank you. Yeah, I'll go ahead and put that topic then in our parking lot as we eventually discuss staffing resources in 2023. Thanks.
No problem. So a couple key things to just note in the financial statements. And again, I didn't print out all of those for you. Something I did email to the committee when they were issued. Hopefully you received those. A couple things to just note on the financial statements that I'll just bring up as maybe highlights. One of the things that is moving around a lot is your FEMA money. You received a significant amount of FEMA money in 22, and then you continued to receive a significant amount of FEMA money in 23. So there's continues to be a pretty significant, what we call intergovernmental receivable, which is an amount due from FEMA at the end of 23. What year am I? This is 22. The end of 22, there was still a significant receivable from the FEMA grants at the end of 22. And that's being reflected in what we call a non-major governmental fund. But because of that, I think in non-major governmental funds as total, you had $59 million of receivables from granting agencies. The majority of that is related to FEMA. So the reason that matters is because FEMA, just the nature of FEMA is such that you don't get paid when the expenses are incurred. It often takes years to receive that. The general fund has advanced money to cover those amounts. And so about $26 million has been advanced from the general fund over to those funds to cover those longer term receivables that FEMA is paying. And most of those, if I remember right, Alden, most of those came in 23, a large portion of them.
Approximately 78 million of FEMA COVID came in during the 23 year. And I believe a portion of that is being reflected in this one, and the balance of that will be reflected in the 23 financials. There were a few $1 million in earthquake as well, but as you're all aware, I've tried to get all the COVID money back. There is some COVID money that actually came in the first couple of months of 24 as well, but the vast majority of COVID out of the 126 million, 76 or 78 of that came in 23. But we're not allowed to put it all in the years. So that's why our fund balance, which I'm sure we're going to talk about a lot now and into we're not able to reflect a current number because we're only able to put a certain amount of it in 22. So trying to give accurate numbers today is difficult because you don't have anything hard copy that reflects all of the reimbursement at this point in time.
So to that end, $26 million that's advanced to those grant funds to cover that timing difference between when you've incurred expenses and when FEMA pays you for them. 26 million of that is being deducted essentially from general fund balance. And so that's required to be reported as non-spendable, meaning the general fund can't turn around and spend that money because you're holding on, you're having to cover those expenses in the grant funds until they're reimbursed by FEMA. So that's why the accounting standards require it, because you don't have access. In theory, those monies are not available to you in the general fund because you've already kind of used them park them over here as you were until FEMA can reimburse you for them. So that is causing part of the general fund balance story. The other thing that we'll just quickly talk about now, but is also something we have as a recommendation is the IT internal service fund also has a deficit in it, and that's about $27 million. The general fund's also having to cover that deficit in the IT internal service fund. So that makes up the majority of the unassigned deficit in the general fund, which at the end of 22 was reported at 59.6 million. Keep in mind that overall, the general fund does have 52.79 million in fund balance. Just a portion of it's restricted, about $2 million. 59 million is non-spendable because it's being used in these other funds and has been advanced there. And then you have an amount that we consider to be kind of committed, which is your reserves that you as an assembly have voted on and required to be kind of set aside in that respect. So overall, there is fund balance in the general fund. It's just being allocated to certain things and set aside for those things until some of that stuff is resolved.
Got it. Go ahead, Mr. Thurn.
So I wanted to specifically talk about my least favorite subject, which is this $27 million that Joy just mentioned. And through the research that I've done, that is not something that happened in 22 where all of a sudden, poof, this happened. This is half of the SAP loan from 2018, most likely, that's been sitting out there in the this IT land, and maybe as a short-term receivable or short-term whatever, that now was reclassified into a longer-term thing, which went directly to our bottom line of our fund balance. And it's a huge number. We went from a positive number of a fund balance for 22 to the largest negative we've ever had because of this accounting change. I've certainly have had conversations with the administration and obviously OMB director as we move forward. This is money that ultimately the Muni will end up paying back itself for the SAP loan that is being paid off. But this, in my opinion, it's not a 22. It happened in 22, but it wasn't caused by 22. This had been out there for 4 or 5 years. And then all of a sudden it showed up here. So when we see a fund balance from 21 and then we see a fund balance number in 22, it actually got worse. And as you know, I'm always answering these questions on well, how is that supposed to happen? Because COVID, you got all this COVID money back and you're getting this money back. Well, it doesn't matter how much money I get back when we start taking $27 million accounting hits on things that are out there. So just know that's where it came from. It's now been reflected in the 22, which is affecting our 10 and 2 bond ratings and all of those things. And that was a last second impact on what happened with our bond rating S&P type thing, because I had expressed that it might happen and it ended up did happening. So at least they were aware of it, but it went directly to our numbers, which ultimately affected our ability on what the bond rating was with that particular entity. But that topic is a topic that should be close to heart going forward.
Thanks. Mr. Falsey?
And I'm going to add some color commentary, which could be risky because I'm probably on the caboose of this train, but I think it is accurate, and these guys will kick me under the table, that number one, this causes a problem for the assembly because it means that any additional dollar that didn't get spent in 2022 is now unspendable because the fund balance is at a negative position. But in the long term, the assembly doesn't have to worry about it in terms of municipal health because it is a self-correcting problem. And the kindergarten model that I have in my head, which these guys will kick me if I'm getting wrong, is that when we bought SAP, we fronted all of the cash, and then we said we were going to amortize that process, that we're going to depreciate it over a certain amount of time. And then we said we're going to collect the money from the general government users over a longer period of time. So this was almost a known issue in the sense that it would look like there was a big deficit, but it self-corrects. We're in the moment now, though, where this accounting change now meant that designed deficit position is now hitting fund balance in a way that actually causes a policy issue for you because there is potentially some spendable money, which is now further in the future than it would be otherwise. But all that is to say, we're very aware of this one. We're digging in. We're trying to get fully up to speed.
Great, thank you. Myself in the queue, and then Member Brawley. So I guess a question for Ms. Mariner, and then a question for the administration. So was it a change in accounting standards that led it to go from short term to long term, or what caused that classification change?
Sure. No, there was no change in accounting. So in the past, we've been told that there were plans in place to remediate some of the balances that were there. Also, the amount of that increased about $9 million in 22. If you look at the IT Internal Service Fund, it had a loss this year of $5 million plus another transfer of a capital asset over from that fund to the general fund. And so the number became pretty material this year. Because of those things that happened this year. Also, this is the first time your financial statements have been issued past a whole year after fiscal year end since SAP happened. And so it became very clear to us that their long-term is defined as more than 1 year. So if it had not been resolved within 1 year, I mean, there's no way for us to audit it if we're looking at it 7 months after year end. Maybe there is a plan in place that could resolve it. Unfortunately, in this case, we knew it hadn't been resolved in 1 year because it was already after 1 year and it hadn't been resolved. So there wasn't any kind of coat hanger to hang your coat on this one. It was clearly more than 1 year due. So one of our recommendations in our wrap-up document to the audit committee is to look at your recovery of your internal service recovery costs, as you call them ITGCs here at the municipality, but it's those intergovernmental charges. Are you charging the departments enough to cover the costs, the true cost of running the IT fund? There are some funds some activities being charged to the IT funds that happened in 22. So this is a couple years old, that probably shouldn't have landed there because they don't benefit the whole government. The CAMA system, for example, was initially recorded over there. So a little more attention to how those internal service funds are being used and recovered is probably warranted. And our recommendation there is to do an analysis or hire somebody to do analysis to ensure that what the municipal manager is talking about actually happens, that the internal service funds do recover enough to cover the actual costs of not just SAP, but other IT systems that you're implementing over time.
Got it. Thank you. And then I guess a question for Mr. Thurn. If I heard correctly, you talked about this $27 million being half of the loan for SAP. Does that mean that we're expecting another $27 million in the near future? Or can you help me understand that?
When I looked into it and when I asked, this was like last October, when the IT department was like, why is our account fund balance so big and negative and all those kind of things? When we looked into it, we were told that was half or included half of what the SAP loan was at the time of the original decision. And that the half that was going to be paid off in IGC was already in our budgets and so forth, and that this other half was stuck out there in this separate account to be dealt with at a time in the future. Because, and this is my suspicion or my belief is, if you put all of that in there, then you're having the budgets be hit immediately by all those departments to a significant amount, which means they can't hire police department officers and all that. So if you split half of it and IGC that out, then that way you're affecting the budgets to a smaller extent. And then at such time as that one gets paid off, then you move the other one in there and you just continue paying off that half. But you're out there in such a long time period that it takes a long time period to be able to do that. But now that we've moved, it wasn't affecting our fund balance at that time because it was sitting in the IT one, not in our general fund balance, which has all of the 10 and 2 requirements and everything up against it. Now we are, because of this move, it is directly affecting our ability to spend money on anything we want, as well as our bond rating code requirements that we have out there. So this switch is actually fairly significant And the conversations we'll have with the administration is there anything that we can do to try to either chip away at that, reduce it? But at this particular point, it's going to be a drag on the fund balance for the foreseeable future. That's going to affect, as I think, as Bill stated, a variety of future decisions that are going to need to be made. I guess, one option is we could IGC a larger amount, and then that eats that reimburse. Remember, you're IGCing to reimburse the fund balance or reimburse the thing. So if you take a larger amount out of people's budgets, let's say in 25, you would start shrinking that loss going forward. But that's a large number, and there's a lot of departments that have needs and staffing and so forth. So we have a variety of balancing act that you'll have to be doing with how do we pay off some of these things that are affecting our different fund balances, as well as deliver, the quality services that we want on a yearly basis for the city. And that's going to be a lot of discussions and I'm sure going forward.
Got it. Thank you. Member Brawley.
Yeah, thanks. I have a couple questions and I guess an observation. Having been involved in discussions around other topics that we haven't brought up today, like the building safety service area, but these other things that are basically accounting issues in the end, and their policy choices as well, to some extent. And it strikes me that just how much, or I should say how complex the financial management of a city is, and especially a city that owns this many different assets. And I know that's been brought up before, that we're unusual in some ways in that respect, maybe compared to other cities of our size. And also, we know the financial world around us is also evolving. It's getting more sophisticated. It is weighing in on things like climate change, which has come in, recently. We know insurance costs are going up because there's these issues of liability and how we pay for things. Anyway, all that to say, I think I appreciate the work that's being done. And I think it is something that we need to pay attention to. And we're really inheriting a lot of problems, or maybe things that didn't look like problems at the time, but are just things that we need to change or we need to fix. And so that's kind of the big picture. I'm interested in that conversation, and not necessarily coming at it from a posture of, we have to find ways to, for example, cut the budget or things like that to solve this, because I don't think that solves the big picture issues, even if it is an accounting thing. So going to my two specific questions or topics of discussion, fund balance. So I understand the rationale. I understand we have to meet certain requirements. I guess I also observe that, for example, with FEMA, we know we're going to get the money back from earthquake. We don't have it now, but it puts us in a position that even though we know that hole is going to get filled, 5 years from now, whatever it is, so some point in the future in that situation, that we are still basically unable to do anything other than just keep filling the hole that's there. And so I just wonder, I guess it's a question for Mr. Thurn and Mr. Falsey, can we make policy choices like, for example, knowing we will get the FEMA money in the future and holding that part of the missing fund balance separate from these other conversations? And I don't know if that's an option, but I just wonder, because again, it just seems like basically then we've already spent that money, and so we have to just wait and not do anything for 5 years until we get it back, even though we know we're getting it back, right? That seems to be a challenge.
Through the chair, Ms. Brawley, you are 100% correct, because we've talked about these things. It's not just the 27 million, and it's not just the fact that we don't have all of our earthquake money back, or the 1 million that we're still missing from COVID. It is the fact that we have 14 million negative in our BSSA. We're 10 to 12 million negative in our workers' comp fund balance. And all of those things affect our fund balance. So even if we get all the earthquake money back, which $5 to $10 million more that we have out there, and we get the million, we're not, even when we reflect all the COVID money that came in last year, which is going to make us positive, that there were tens of millions of dollars. It's not going to get us back close to the 12% anytime in the near term without these other significant drags on our overall fund balance being addressed as well. And through the wisdom of the Assembly this year, you did at least put in that 0.045 in the BSSA to at least stop that one from growing, but it doesn't fix the $14 million negative that we're already incurring on that. So unfortunately, that how we fix that going forward, is can be done with a variety of different things. But I do believe that those numbers that we're talking about are so significant and so large. The earthquake is not going to be the savior. Yes, it will help. The other thing that from last year, which we have to obviously close the year, is, but we know that our expenditures should come in less than what was budgeted because of our staffing. That will help our fund balance, the dollar amount and so forth. But I can 100% sit here and guarantee you, we're not going to be hitting our 12% in the next couple of years without significant decisions and improvement in some of these other areas that are being a drag on our fund balance. It's not just COVID. I know you were all hanging on getting the COVID money back, and we're going to get 100% of it back, but there's all these other factors that are weighing down the fund balance that are going to take a while to be able to get out of. And unless there's some unknown revenue that's going to come in, it's going to be through policy decisions and determinations of where to spend money and how we try to rehabilitate some of those fund balance drags that are currently existing, that have been growing for many years. I know you and I spent a lot of time talking about some of these things, and they're not brand new things. I mean, when we looked at the BSSA, that's 15 years worth of effort, and now I raised it as a problem, and now we're starting to take a look at that. But it's not something that just happened overnight, but now we are feeling the effects of that on our fund balance.
Yeah, thanks. And just briefly, I do have a second question or a different topic, but yeah, I think the thing that comes to mind for me as a policymaker is how do we frame and have this really honest conversation with the community, with the public, about what it costs to run a city of this size? Because I've said it before in many contexts, but we have built in many ways a city that we cannot afford to maintain. And that needs to be a really honest conversation. And I know people will not want to hear that. They will be skeptical. They will think that we're overspending or wasting spending. And I just think from an organizational perspective, that's just not true, right? That the world has changed, and we have inherited a lot of costs that maybe could have been better managed in the past, but we are where we are. So anyway, I'll get off my soapbox. My other kind of specific question, and again, we can take it offline. IGCs. I hear you about increasing the IGCs, the intergovernment charges. I also think from an outsider perspective, it is a black box, and it looks like maybe a way to, it seems like they're always increasing, right? And so I think I think we need to have a conversation about what they're doing and what they're for. And the reason I bring that up is because, for example, in alcohol tax, and then we will see in marijuana tax as well, to the extent that IGCs keep increasing and taking more and more little parts of that dedicated funding. And I'm not questioning the validity of why we do that, but I think, again, it's the more administrative, the more overhead cost we have, the less we have to use those funds for what they're intended, right? And so I just bring that up because I know those things, I've watched those go up in the budgets that we have for alcohol tax. Again, I understand what they're for. Alcohol tax is not general government, for example. So I think there's things to sort out there. But again, it's just another thing that I think about, like if there's a way to more clearly articulate what those are for, and be able to speak to why those go up, for example, I think would be helpful. And again, I know that's a conversation probably for offline, but I appreciate the thinking about increasing IGCs for IT. But again, I don't want that to start eating up all of the rest of the budget, right? So I think that's also a policy conversation we need to keep having. So I don't know if you have other comments on IGCs at this point. Otherwise, we can take it offline later.
No, I think I stated, kind of my concerns there. That's how we would pay for them. And as I stated, that's the policy decision then between the administration and the assembly that you'll have to work through. Yeah, you could pay the entire $27 million off next year in your budget, but you're going to have to get $27 million from the departments to be able to do that. I don't believe that's a realistic thing by anybody. And that's why I believe that it's going to take many years for us to be able to recoup that, but the funding mechanism is the IGC to pay those loans back, specifically for some of these IT. And don't forget, we've got an IT upgrade in SAP happening over the next 2 years. That was over $3 million, paid for by a loan that's going to have to be, reimbursed at some point in time. So these large expenditures that we have that are for software we have to pay them back, and the only way to do that is to be able to take it out of the funds that we have available to us within our tax cap, and that's staffing and debt service, so to speak. So I'm not the person here to say how you do that. I'm just trying to inform everybody that it is now, I know the question I always get asked, how much fund balance do we have that we can spend? We are negative. So there is no fund balance to spend, and it's not going to be anywhere in the near future until we are able to reimburse the fund balance for multiple areas where we've been dragged on. And that's going to be a discussion of how much we can do, how quickly, and still provide the great services to the citizens of Anchorage that you all expect.
Great, thank you. I want to note for the record that Mr. Constant joined us a few minutes ago. Back to BDO.
Thanks. Well, I just maybe in the interest of time, Mr. Chair, is it okay if we move on to the results of the audit and not through the details of the financial statements? Okay, I will just comment on this. I've already met with the administration, and I'm happy to be assistance like on the conversation, for example, on the internal service funds and how the cash flows work, and possible ways to stay within the accounting rules, but also brainstorm ways that you can improve the recovery there. So, I'm happy to help as I can on some of those areas, because I think sometimes the financials are, the cash flow is sometimes different than the results of the statements, for example, with depreciation and some of those things. So I'm happy to help there if it's prudent. But I also just want to say on the financial statements, the financial statement audit was released on July 12th. The financials are representative of the results of 2022. So, when we look at kind of the results of the audit, that's kind of where I want to go next on the audit wrap up, which of course I don't have my own copy of. Here it is. You can have yours back. So the audit wrap up is the results of the audit, and a couple of key things. This is one of the handouts you have. It looks like this. And we report to you as the Municipal Audit Committee. We work for you as a Municipal Audit Committee. Management has to put up with us because they have to give us all the information we need to do the audit, and we work very closely with management, but ultimately we report to you. So it's important for me that we go through at least some of the highlights in this audit wrap up with you. A couple quick things. If you go through to page 5, I think is where I want to start. So the audit was completed. We audit the financial statements, but we also do a compliance audit of the federal and state awards. And a couple quick things to note. The first bullet point, keep going, sorry, right there. Yeah, the first bullet point here talks about what the objective of our audit is. So one thing just to remind you of is that an audit obtains reasonable assurance, not absolute assurance. So we're looking for things that could have a material impact on the financial statements, something that would mislead a user of the financial statements. Primarily, the users of your financial statements are you as the audit committee, the assembly. Management uses them a lot. Also would be citizens of the municipality or granting agencies or your bondholders. Those are all users of the financial statements that we consider when we determine whether something is material. And I will just say materiality is not entirely a formula. There are things that, like an estimate or a significant unusual transaction where a materiality level might be a little lower. Our tolerance for error would be lower on something that is maybe more susceptible to fraud or might be a higher risk area. So just know that we're not looking for absolute assurance. We picked a lot of samples this year, and some, Alden's shaking his head. In some cases, we had to select enough to get comfortable with the number because we found issues or errors in our initial sample. And so while we do select samples, we don't typically look at everything. We didn't look at everything. We didn't look at every paycheck or every timesheet or every grant. But in the case of, say, grants, we ended up looking at most of them in order to get comfortable with the numbers. Our scope was essentially the same in the sense that the areas we needed to audit did not change from what we talked about back it's been a bit since we talked about our plan for the audit. But we did change the timing, obviously, just based on the timing of the information we received. We did issue an unmodified opinion. That's the clean opinion that you as the audit committee should expect to see. And the report was issued on July 12th. We also issued 3 other reports. Government auditing standards, which is a more robust form of audit. Also, your schedule of federal awards and schedule of state financial assistance were both included as supplementary information. And then we do compliance audits for state and federal what we call single audit. So we'll cover those really high level. We did have a modified opinion on your uniform guidance. That's your federal compliance report for certain major programs, but an unmodified opinion for the state of Alaska audit guide report. Very high level summary. I'm going to cover a couple of more specific things in a little bit. And, the next page there just really talks about the fact that we also look at other information included in your financial statements, which this year really doesn't have a whole lot more. You didn't have an MD&A or statistics, as Alden mentioned, but we do look at your pension schedules, budget comparisons. You have a transmittal letter, for example, in your statements that we do look through. And then I just want to say that there have been a lot of people involved in this audit. When we started, you had a different CFO, you had a different controller, you had different people as acting controller. Then in the meantime, you had several people in the CFO role over that period of time, and everybody had a part to play in getting this done. And it's been a big lift for everybody. So I just want to thank them. And we had people who were helping us even in the last week, like we needed one more thing on this to get you out of a finding, or one more thing on this to document something. There were people in purchasing, OMB, all across the municipality who stepped up to help. So I just want to thank your team here. And I know not everybody who was part of that is here still, but maybe still able to listen to this. And I just want to thank them for their professionalism and for their help. Next page, let's talk a little bit about kind of big things. You did adopt a new standard this year. That's the leases standard. We talked about that at the beginning of the audit. And then next year, you're going to adopt another one, GASB 96, which is essentially leases for subscription-based IT arrangements. It's an IT contracts analysis, essentially. And then you do have quite a few estimates in your statements. I have some of them listed here, the bigger ones. Just know that these are numbers in your statements that aren't necessarily hard and fast numbers, meaning it's not a dollar sitting in a bank account that I can see. It's an estimate of how the number is ultimately going to end up. So for example, your landfill closure liability is an estimate based on what you think it will cost to close your landfill when it does close. Or your depreciation of your capital assets is based on useful lives. Pensions are handled at the state level, but you have estimates for self-insurance liabilities. For some of your investments are estimates, how much you're going to collect in your receivables. I will say a lot of these, if they're able to be known, a lot of them after time, you kind of know what they are, right? For example, landfill closure liability, when you close the landfill, you'll know how much it cost. But it's an estimate that maybe it's 15 years out before you have to close part of the landfill or close a cell on the landfill. So estimates are based on the best information you have at the time, and you do hire experts to assist you with that, or actuaries, for example, are hired by the state for the pensions. The first one there I'll just mention because this is new, discount rate used in lease calculations. The way leases work now, and I'm going to quickly show you that in a little bit when we talk about the implementation of GASB 87. So when the municipality goes out and either leases property to someone else or you lease from somebody else, now with GASB 87, you say, okay, and this the very material, for example, at the port. You have some very material port leases. You say, okay, we're going to lease this property to someone else, to one of the users of the port. And they then pay you based on a contract agreement. And you value that contract agreement based on the payments they're required to make, extensions, and the likelihood of whether those extensions will be exercised, discounted to essentially today's present value using a discount rate. And that is quite complicated here at the municipality because your leases are quite complicated. You lease space out at the port, also at the airport. Merrill Field has a lot of leases. And then you do have some leases where you're leasing space or property or equipment from others. And so the discount rate that you use as an estimate, and it's based on different things. In theory, you would base it on an incremental borrowing rate. Some leases might have it stated what your interest rate is, and your incremental borrowing rate might be different for, say, the port than it is for general government. And so just to know that that was a challenge this year. There were some discrepancies in the kind of values used for those discount rates and misunderstanding of how the standard should be applied. So the leases did result in a lot of audit adjustments and a lot of extra work this year. For GASB 96, we've already talked to the administration about implementation of GASB 96. A lot of municipal governments of your size have hired people to essentially implement either GASB 87 or 96. That wasn't the case for you, but I would just say that the standard is a bit complicated. And what it results in ultimately is a right of use asset and a liability, a lease liability, if you're leasing from somebody else. Because if, let's say you're releasing a building, you now have the right to use that building. So you record an asset, and the liability is how much you're required to pay, discounted, almost like debt. The opposite is true. When you're leasing space out, say at the port, you would have a lease receivable and then a liability because you have an obligation to let them use the space. So it's really blown up your balance sheets. Things look a lot, new numbers on there that I'll let you all determine how valuable they are to you. But they do tell you a bit of a story of how much value you have in, say, port leases. How much value do they provide in present day dollars, which is, that's what the bondholders supposedly are looking for, is what the value of those things are. And just as an example, your lease receivable at the port, the long-term portion is almost $53 million. And that's what the value of those contracts represent over the life of those contracts. So some pretty big contracts that are reflecting on your balance sheet now that weren't there before. I think on all of your enterprise funds, that number is, in the long-term portion, is 68 million. So you have quite a lot of leases. I think that a lot more than I think people anticipated walking into that project. Okay, questions on this page before we kind of talk about a few big things? Okay, I'm going to try to fly here a little bit. Next page is about just the big highlights. So if you were to step back and say, what are the major things that happened in 22? The GASB 87 is certainly one. It's hitting several of these things because it's a new estimate. It's a new standard that you're implementing, brand new practices, policies, procedures around it. Significant unusual transactions, the biggest ones being FEMA revenue and the recovery of that. You did issue new bonds, which isn't very unusual for you to issue bonds, but it is a significant transaction. And then the advances to other funds, which is what Alden was speaking of previously, that primarily that is related to the IT fund, although the state grants fund also has advances to other funds until FEMA is resolved. Disclosure wise, mostly it's leases. You did have some subsequent events disclosures, things that happened after year end, primarily around debt issuance. And then GASB 87 is your new accounting pronouncement. Nothing that we consider to be an alternative accounting treatment, meaning there isn't guidance out there in the accounting world to assist you with those transactions. So none identified there. Let's talk quickly about the results of the audit. So this is where I start losing people a little bit. So I didn't list out the journal entries for you on the next page, if you can flip for me. But there is a schedule attached to this document that walks through all of the journal entries. I will say that, I don't even know how to tell you where to find that. So it's kind of towards the back. There's a schedule of corrected misstatements and then a schedule of uncorrected misstatements. So there were a significant number of journal entries that were recorded this year. And the journal entries range from closing entries that were received by your team after we received preliminary trial balances. Either they were still working on them or we said, hey, this doesn't look right. Can you take another look? And they went back and looked to try to correct them. The largest ones related to and we can talk about that, when we look at it, but the largest ones related to grants, transfers, leases, a couple other areas. Let me just quickly not speak out of turn on that. I'm going to read them here really quickly. So the largest ones related to fund balance, transfers, capital contributions, grant revenue. The landfill closure liability was adjusted. Unearned revenue and deferred inflows in the general fund. Some of the same at non-major governmental and the disposal utility, which is part of solid waste. And then inter-fund balance classifications were adjusted as well. We did find other adjustments that maybe weren't material to cash and investment balances and classifications, investment income, interest, transfers, debt, and accounts payable. So just from a lift on the audit side, when I just kind of talk about this at a high level, auditors are meant to come in and audit the numbers once they've been finalized. And there were quite a few adjustments to get the books and records in line with accounting standards. So that's what the audit adjustments are meant to reflect, essentially to get the financial statements in line with generally accepted accounting principles in order to be able to issue a clean opinion or an unmodified opinion. Uncorrected misstatements are things that we identified that were errors, and they were not recorded. In a couple of cases, they were known by management. They decided they didn't want to record them for various reasons. Some of that was largely related to timing, just not enough time to try to look into them, and they weren't considered material enough to merit holding up the financials. So that's a little bit newer. In the past, we haven't had this level of past adjustments, what we call past adjustments or uncorrected misstatements. Most of those related to just final true-ups for leases and grants that the schedules were still not quite working, but we got them to where we all felt they were materially correct. The errors were not run through afterwards. And then we also had adjustments that were not recorded related to legal settlements. Because those legal settlements occurred in 23 or 24, the decision was made and they were paid in those years. The decision was made not to accrue them back to 22, even though they did relate to cases that were open at the time. So that's something that we discussed with management, and the idea there is to try to best match the budget and the assembly appropriations with the financials. But in theory, accounting principles require you to book estimates for legal contingencies in the year in which the claim would have been generated, or the event that caused the claim had occurred. And then there were some other adjustments to grants that were finalized pretty late in the process, and it was determined, just in the interest of time and with the dollar amounts, it was not worth running those through the financial statements for 22, and the goal would be to correct them in 23. I will just say, at the end of the day, the grant schedules and the lease schedules, when you read my opinion, we believe the financial statements to be materially correct. There are still some adjustments and issues that your team is working through on both grants and leases in order to move forward with those and feel really comfortable about every line item on there, which is why our samples for those areas ended up being so large, because we had to get to where we were comfortable materially with the numbers, and the sampling didn't get us there. So we had to substantively test grants and leases, I would say those two areas specifically, to a level of detail that we don't typically do. So I am not going to go through all of the attachments with the journal entries, but I'm happy to answer any questions. Go ahead.
Okay,
So
perfect.
Yeah.
So on the uncorrected statements, for folks following on page 9, you do have a little bit of a cautionary tale about how these uncorrected statements could potentially cause future period financial statements to be materially misstated. Do you have any specific concerns about that happening in the municipality? And I guess to the administration, like, do we have plans to deal with these so that we don't have material mistakes in the future?
I'll take the first part of that question. So the reason we're required to put that in there is something might not be considered significant or material in the year we're auditing, but the next year, the impact of that could be considered more significant, just depending on the activity for that year. That being said, we carry these forward to the following year's audit and evaluate them as part of our audit for the following year. So that would be a known carry forward impact. Some of these really have no effect on your fund balance, say, for example, at all. And so they really don't need to carry forward. Rather, they just need to be considered by management, corrected in their schedules, and then recorded on their end. But they might not have a net impact really to your fund balance side of things. So I don't know if Alden, you want to take the other half of that question?
Not really. I have had several conversations with Dawn and I know Yoon, who's one the deputy controller as well. I'm most concerned about any of the items that were off book entries that in order to get our ACFR correct, that we ensure those entries are made in our 23 financials in January immediately, so that our starting point in 23 matches up to hopefully perfectly, but to what the ACFR was for 22, because my biggest fear is if all of those don't get actually put into SAP, because they were done outside of SAP, that we will never be able to get 23. And I think we had some of that in the 21, 22 time period, where entries were made off books in 21, then everybody quit and they never got in there. And then the new staff in 22 were trying to figure out why our books with the ACFR didn't match up to what was in SAP. So I've really made an effort in our conversations to try to ensure all of these entries that are listed and have actually been taken care of, put into SAP, so the greatest degree possible, our books match what SAP matches what our ACFR is, so that at least our starting point can be spot on, and then the activity will just happen in 23, so that when we do the trial balances at the end of the year, we're not trying to figure out why we didn't start at the right spot, and because we're never going to have the right numbers if we didn't start in the right spot. So she and I have had several conversations about this, and that's kind of my highlight right now. I have been led to believe that the vast majority, if not all of them, have been reflected, but I'm just asking her to go back through and validate that. And there are several pages of entries that we were talking about here, so that we can at least be in as good a starting position for 23 as we possibly can as we go through it.
Great. Yeah, thank you for that thorough response. I appreciate that. I guess for my part, I'm going to add that to sort of a parking lot of stuff to talk about with regard to the autopsy, because I do want to dig into that a little bit more. Okay. Not seeing anything else. Please continue.
I'll turn this on. So we are also required to report to you items related to internal controls. So we are an external control. When we receive information, for example, and we see there's an issue with it.
Sorry, I have to interrupt you. I'm just looking at the time. Approximately how much more time do you think you're going to need? I know
I can take as much time or as little time as you'd like, Mr. Chair.
Okay. Yeah, let's do 20 minutes, because I think there's still a few pages of, I think, meaty stuff that we need to go through. So then can I get is there any opposition to extending 20 minutes? Okay, great. Then not seeing any on this side either. Okay, so then we're extended by 20 minutes. Just so I can get this out of the way quickly, primarily because I don't see anyone there. Is there anyone who would like to participate in the audience participation? Not seeing any? Okay, we're done with that. So go ahead.
Thank you, Mr. Chair. So internal controls are very important. When we receive information, if we identify issues with the preparation of it, the review, if there are errors, that would indicate that there would be a deficiency there. There wasn't an adequate review or reconciliation or there was not a check in place to ensure the financial information was recorded correctly. We're required to report in our government auditing standards report things that we think merit your attention. That's what's considered a significant deficiency. And a material weakness is something that could cause a material misstatement in the financials. So when we look at these, and you can go to the next page, we do have items that we've reported as material weaknesses and significant deficiencies. The most efficient way to look at this, and hopefully you've, spent the 12 hours to read all this in advance, I'm sure, in all your spare time, is the single audit report. So the single audit report is the other handout I handed out on paper, but it was also attached to the meeting materials online. The single audit report details out each of these with a lot more information. So for example, if you turn to the single audit report, and you don't have to do this on the slides, I don't think, but if you turn to the single audit report on page 29 of the other packet I gave you, that will give you the detail of the number 1 closure of books and records material weakness. And so each one of these has a write-up that provides information about the criteria, which is just, why are we even bothering looking at it as your auditor? What standard requires this? The condition that we identified, the cause that we believe is the reason behind this issue, what we think the effect could be, and then our recommendation for remediation. Now, our recommendation is just a recommendation. It's not a have to do. Management has their own view on this and their own corrective action plan. Their views of responsible officials is also included there, which includes a very summarized version of their corrective action plan. And in the back of this report, there's a detailed corrective action plan for each one. So if you want to see what they wrote, the back of this is what they wrote. It's on Alden's letterhead, so I guess you get credit for it. And we just have a summary sentence of that. So I guess it's kind of up to you. I know that you've had a chance, I had a couple weeks with this to live in it after I lived in it for a while. The other thing I'll mention, so we can go through and I can answer any questions on any specifically, but let me just, really briefly mention each one of these and what they mean. So closure of books and records really is just the timing of this. It was done late. It's when you have late financial information, it's difficult for the users to make timely and informed decisions. The next one relates to reconciliation and review controls. As I mentioned before, we had significant material journal entries in quite a few audit areas. And so that would indicate that there were some issues with the reconciliations being done properly and being reviewed properly. And the main cause for that is staffing turnover, and I would just say a large volume of activity with both FEMA and the COVID-19 pandemic. Internal communication is number 3. And one of the things that we kind of just found, generally speaking, is that there were several key areas of the financial statements that were impacted by, lack of information between departments, specifically those related to things on debt covenants, cash and investment, restricted assets, indirect rates, and even capital assets. It requires a lot of interdepartmental communication, and a few key employees who are managing those things in the past seem to that might be that those control owners were no longer at the municipality. The next one was related to use of fund classifications. Largely, this one is a repeat from last year. If you remember last year, we had some issues with expenses being recorded in a special revenue fund when there wasn't a revenue to go with it. This one really this year, same type of problem, except it was related to the internal service fund being used to track governmental capital assets that were not really part of the entire municipality. The next one, implementation of leases. That is a typo, and it should say GASB 87. GASB 87 is our lease standard. We had material adjustments to leases. You can see those, I think, $43 million to lease receivables. Pretty material adjustments to right of use assets and lease liabilities. That was 42 million, 43 million on one and 42 million on the other. No, they're not related. That's just luck. And then, so our recommendation there is just really careful implementation of new standards and revisit your leases. Tracking of capital assets, we had some pretty significant adjustments to capital assets. About $19 million of assets were improperly disposed of on your capital asset schedules, and they were added back, which is good once they were identified. The assets appear to have been fine. They were still there. But the tracking of those was done in error. The next one is related to the timing of your deadline for the federal single audit, which is also that last one, 14. The deadline for the federal single audit is 9 months after year end, so September 30th, and that deadline was not met. The next two relate to your federal or state single audit. Those are both federal, actually. And so before we look at those two, I just want to refer back to what your major programs were this year. And on the federal side, we audited, 7 major programs in 2022. We audited airport improvement, your highway planning and construction, federal transit, emergency rental assistance, and then we have 2 COVID grants. One is the coronavirus state and local fiscal recovery. That's your ARPA money. And then you got an epidemiology and laboratory capacity grant. That's what's called ELC from Health and Human Services that we audited. And then you also have the CCDF cluster, which is your child care development money as well. So we audited all 7 of those programs on the federal side, and on the state side, we had quite a few state programs as well. The big ones being your grants to municipalities, which is this kind of larger bucket for DCCED grants. So they give you money for lots of things. The big ones there were your Eagle River Traffic Mitigation Grant. You had a little bit on roads for Mountain View Drive and Norm Drive in 2022. And then we also audited your Human Services Community Matching Grant. And I think that's it on the state side. So the 2 federal findings, one is a repeat, the subrecipient monitoring program project there. You're required to monitor subrecipients. This is for your ARPA money, coronavirus state and local fiscal recovery, emergency rental, and also your ELC grant. All 3 of those had issues with your follow-up with your subrecipients and documentation of whether they got an audit if they were supposed to. And some of the subawards still did not include the required language. The next one related to the 2011 finding. Let me just pull that one up really quickly, is equipment and real property management. And that really is just a matter of tracking what equipment you've purchased with federal money. In this case, it relates to your ELC grant, and there was six items where they weren't maintaining your fixed asset record. So let me just start over there. We tested 6 items. One of them was not being tracked properly in your equipment records. So that's a federal compliance finding that we reported. On the significant deficiency side, there was insufficient tracking of your restricted cash and your debt covenants on the municipality side. And then the other 5 items here relate to federal or state single audit items, again, related to procurement. This is actually a repeat of last year in terms of just having the correct documentation for procurement for federal funding. That actually relates to several of your major programs and whether or not they had evidence of searching for a suspension and debarment. Actually, this requirement's changing in 2025, so we can talk about that and how you have to change your reporting there. And then also some more problems with your equipment and real property management, and a few late reports on the state single audit, and that the state single audit that related to your Human Services Community Matching Grant, 1 financial report and 1 narrative report were submitted late for that program. So those are considered significant deficiencies. They merit your attention. You need to know about them, but we don't believe them to be material noncompliance or material weakness. I know I just spit a lot of information at you, and there's about 30 pages of single audit documentation to support that. So I don't plan to read each page of that document for you. But if you've reviewed that and you have a question about any of those in particular, I'd be happy to answer that now or at another subsequent meeting. So with that, I'm going to turn it back to you, Mr. Chair, before we conclude with my next slide.
Great. Thank you. Member Brawley?
Yeah, thanks. I guess my question is really looking ahead to 2023. I understand some of these things were maybe one-time changes, like you mentioned, the lease standards changing or things that we've corrected. It seems like we have reason to believe that when we get into the 2023 books, we're going to have a lot of the same issues with the internal controls or things being done incorrectly. If it was the same, kind of the same pattern that continued, can you comment, kind of looking ahead, what you see as maybe some of the challenges or things that you would anticipate being issues this moving into the 23 audit?
Well, I get the privilege of not telling you what I think about 2023 because I haven't audited it yet. But I will say, I would just recommend you look at our recommendations. And the largest areas here related to recommendations are staffing, having adequate staffing for your accounting team. They did have turnover. They didn't have enough resources to get through a lot of the information there. And then some of these are just establishing good controls, which really that means for you policies and procedures to cover some of these things. So, looking into 2023, I don't know if we'll be repeating some of these, if some of them have been corrected. Frankly, some of them may go away simply because you don't have that program anymore, or you spent the money in 22 and not in 23. So we might not have to audit that program. But we will need, as part of our 2023 audit, we are required to evaluate what's called the summary schedule of prior year audit findings. So we are required as part of the 2023 audit to go back and look at how management has addressed the findings reported here and evaluate whether, if they say they've been corrected, do we believe that to be true? So that will be part of the follow-up for the 2023 audit. Yeah.
Great, thank you. So I do have a couple of questions, probably for the administration, but before I get into that, just want to lay a little bit of the foundation for moving on into the future. The goal today, as I stated earlier, was for us to go through the 2022 audit and ask the questions that we have of 2022, and then to begin doing a little bit of autopsy of 2022, which I think naturally when we do that will lead into 2023 and how we can make sure, even though 2023 is already starting, how we can make sure that we are supportive of those efforts going into the future. So obviously, we're not getting to that second half of really focusing on the autopsy in 2023 for today. So I likely will be calling another meeting perhaps in August for us to go through that. So that's just FYI for folks. This is not something that is being ignored by the committee for sure, but it's just we didn't have time to do it all today. And then really briefly, I want to cover a comment that was made earlier in the meeting by Ms. Mariner regarding a possible executive session. This has been communicated with the chair, and I think as was communicated, we on the assembly are very cautious about going into executive sessions. The code outlines the very particular rationale for going into executive session. And I would imagine that the one that is being requested for this particular idea of an executive session has to deal with material impacts on the municipality's finances, as I imagine the rationale. I guess just guidance to you, Ms. Mariner, if that is what you believe the rationale for the executive session is, then I would advise you to work with both the chair and the clerk's office, and they can sort of tell you whether that's if it meets the criteria or not, and then and council will also probably weigh in. Otherwise, if it doesn't meet that criteria for an executive session, that I would suggest you work with the chair, and I could facilitate that as well, to maybe just do a public work session where we work through all of those issues. But again, not knowing the rationale and the reason for requesting an executive session, I would leave that up to you. I don't know if
Sure.
you have a response on that.
Yeah, honestly, executive session's entirely up to you as an audit committee. If you would like me to be part of that, I think there's some significant financial things that we've even touched on today. And if you want to kind of dive into some of those, and then we can touch really quickly on my last slide, which may be another reason that you would recommend to the chair that you would want to have an executive session, but it's not something that I'm requesting necessarily. I just, in this type of situation, something that I would say maybe something that you as an audit committee would want. So this slide I'm not going to spend time on. These are what we consider to be control deficiencies. They are outlined in more detail at the back of this wrap up if you want to read more about what they mean. But these are things that we consider to be almost management letter comments. These are errors that we found or issues that we identified, areas that your team could beef up their documentation on, for example. Some of these were identified by your internal audit department. So thank you, Scott. And we just want to make sure they're on your radar. They aren't items that we believe merit your specific attention to. But they may provide more color in terms of some of the issues that you see in the findings. And then the last slide I want to focus on is page 15. So go forward a couple of pages, maybe. Oh, right here. This is the one. I just want to kind of conclude by, on this slide, there's actually 3 pages here, but I think this slide kind of captures it. There were significant changes to our plan for this year's audit. Not just the timing, the way we audited leases and grants. There were grant adjustments being made pretty late in the audit process, and it required us to change our approach to auditing both leases and grants and do a significant additional work. And I would say that there's some procedures that we performed and assistance that we were providing that was out of the scope of our original audit plan and our original just out of our original plan, but even out of our scope of our plan as of, say, March. So I just want to bring that up. I think it's important for you all to know that, typically an audit comes in, we might have an adjustment here or things that are significant and unusual that we need to discuss with you or that we need to work with management to correct. But this year was, pretty significant changes to the way that we approached the audit, but also to the assistance that we provided to the municipality for completing those books and records. The other thing, and we talked with certain people around this, is that there were certain laws and regulations that we investigated during the course of our audit to determine whether they had a financial statement impact that needed to be evaluated. That did require us to spend some time focused on that area and did require a little more testing around your legal work that you do. And, that's a big shout out to Alden because he had to wrestle with getting attorney letters back and some of those kinds of things. There was some complications around just the testing of legal complaints in 2022. To some degree, that may continue into 2023 because some of those things have not yet been fully resolved. And then the last one, I know I've mentioned it, but GASB 87, I will just say to this committee, GASB 87, while we did implement it, or you did implement it in 22, doesn't go away because you implemented it. It's still a big undertaking, and the work that we did to get the numbers corrected was a big lift, but it will be a big lift for your team to continue that. I'm not going to make the recommendation of which solution that you pick, but you may need to consider a staffing solution or a external consultant solution or potentially a software solution to track your leases. Because the sheer volume of leases that were identified by the municipality as part of the process were well out of scope of what was originally identified. So it was a much bigger lift for us, but also for your team than was initially anticipated. And so I bring that up just because it's something that this committee needs to be asking about. How is that being handled? It was reported as a material weakness. And GASB 96, while not as big of a deal as that GASB 87, probably has very similar types of requirements and is in effect for 23. I don't know where that project stands here at the municipality side, but a lot of our clients have simply purchased software to track all of these things. So I bring that up because I think that's something that is worthy of the committee specifically addressing. And so with that, I think the only other thing on my report, we have in here is that we have to tell you if there's things that, we think indicate fraud or abuse or anything like that. Nothing that we're reporting to you. I know that I was in communication rather regularly with Chair Rivera. So thank you again for your attention to that and being available to discuss the things that we encountered over the course of the audit process. And, big thanks to Alden, and the team that you had throughout the audit was always different. But I know at the very beginning of the audit, Alden was involved with FEMA from the very beginning. And, we were sounding the alarm about the impacts to fund balance years ago, I think now. And Alden stepped up to that challenge and then stepped into this role, which you might be the longest term CFO for a while. Anyway, I'm glad to have you with us, Alden, and thank you so much for being the driver that gets things out the door when they did. So with that, I'll answer any other questions, but I think I've taken your 20-minute extension.
Great, thank you. Yeah, at this point, we only have really time for one more question, and then I think we will be done for today. Mr. Constant?
Yeah, Felix, thanks. You did not complete your sentence when you said we are required to report fraud and abuse, and then you kind of didn't say something and you moved on to a different topic. Can you finish that sentence?
Can I just, I'm not certain what sentence I didn't finish, but in regards to fraud and abuse.
The one about fraud and abuse.
Yeah, so we're required to report to the audit committee any identified instances of fraud or abuse that are required to be reported under both accounting, auditing standards and government auditing standards. And our reports do not include any reported instances of fraud or abuse.
Perfect. That was the phrase you didn't get in the first time. Thank you.
Yep.
Okay, great. So, yeah, go ahead if you want to talk to it, Mr. Myers.
I know it's kind of an Alden question, but I would like to see the MDN, what was the acronym you used in the beginning? MDNA, and a work session for the assembly. Given how far behind we are and that we have so many new members of the body, I think it'd be beneficial, certainly for me, but for the rest of the committee and for the body as a whole, if they wanted to attend a work session to go over that and have, I don't know who would be explaining and walking us through it, but I think it'd be beneficial.
Great, thanks. And yeah, certainly I know that you've talked about, Mr. Thurn, some of the staffing implications for doing that. So I think we'll have some offline conversations just to try to sort that through. Okay, with that, I will go ahead and adjourn this meeting, and likely you will see another committee meeting in August.